Over the last 2 months, the value of crude oil has dropped by over 60% to the current lows of nearly $20 per barrel. So what's causing this? Well, in this video, I'm going to tell you what. Let's get straight into it. To really understand why crude oil prices have been selling off so much over the last 2 months, and to understand why $20 per barrel is such a crucial support, we need to peel back the curtains and not just look at the technical analysis, because there's fundamentals at play that really inform why the technicals are behaving this way. To really understand why oil prices fell from their recent highs of $60 per barrel to their current price of around $20 per barrel, you need to understand OPEC and its major players. Now, OPEC is the Organization of Petroleum Exporting Companies. This is essentially a cartel of the world's 14 biggest oil exporters. It was founded in 1960 with the aim of regulating the global supply of oil. This was done in order to regulate the price of oil globally and make it more profitable for the member nations. So it's basically a legal cartel, but no one could do anything about it because they're so powerful. So when it comes to OPEC, Saudi Arabia are the head honcho, the kingpin, the numero uno. This is because they're a founding member of the OPEC. They have the second largest oil reserves, second only to Venezuela, but they have their own problems. Actually, a side note, Venezuela were one of the biggest oil producers as a nation, but their dependency on oil was partly the reason why their market crashed and now people can't afford food. But that's another story for another day. Now, in early March 2020, OPEC had a meeting to decide on oil supply levels. But in a Machiavellian twist, Saudi Arabia saw this as an opportunity to break rank and dump more oil on the market than agreed. And once this news came out, oil prices tanked. Now, this is the part where we veer off into geopolitical rationale and speculation, but a lot of this stuff has a strong argument. By Saudi Arabia pumping out maximum supplies of oil at a time when global demand is grinding to a halt, they could basically kill off the shale companies who have a break-even price of $40. Now, this is important because the break-even price, by definition, is where a company or industry can start making profits. So if Saudi can weather the storm and cut prices of oil, they can basically force all of their competitors to be producing at a lower price margin and at a loss. Now, Saudi's off again, on again relationship with Iran, which is right now off again, means that they could crush Iran by lowering their prices because their break-even point is much higher than Saudi Arabia's. And in turn, this could lead to domestic riots in Iran and a potential regime change if the supreme leader falls, in the hopes that the new leader installed into Iran's government would decide to focus more on domestic issues and stop funding the Iranian militia who are giving Saudi Arabia issues. Now, armed with the information that we have about Saudi Arabia and their reasoning behind the actions that they've taken, it makes a lot of sense why, when price started breaking this $27 mark here, it dipped down to $20 and then rose back up to $27 and treated the old support as a new resistance. Because this $20 mark is a mental support, because around the $20 mark is where Saudi Arabia's break-even point is. Once price started selling off from the $48 level and bounced off the $27 level, I knew that there was a chance for a potential second short, because when price rose again, it hit the 61.8 level of the Fibonacci before selling off. Now, this $27 point, once it broke through it bounced off the $20 mark and then rose back up to hit the old support as a new resistance. So I made this video because I thought it'd be really interesting to actually get a better look at some of the fundamental aspects of commodities and why some of the things that happens within the commodities market happens, because we can't live in a silo where technical analysis alone can inform all of our decisions. Now, I make most of my decisions with technical analysis, but especially with commodities such as oil and gold, They have so many externalities and factors that affect them, such as geopolitical things going on. And I think it's also important always to stay abreast of what's going on in the wider macroeconomic market when trading commodities, especially oil. So that's me, Any aka the Not Trader, signing out.